Hello and welcome to this video. My name is Jeff Bish. I'm president of MarketGauge.com, and this video is a follow-up to the last blog post I put up on the Hot Scans blog at MarketGauge. And I'm following up with a video so I can show you how I apply the concept that I described in the last post of looking at the new high, new low ratio and having that help guide which strategies you might want to use when there's a significant change. So just to bring you up to speed really quickly, I'm not going to repeat the whole post. You can find that probably on top of this video if you're on the website, and if you're not, you can get to marketgauge.com, go to the Hot Scans blog, and look for the post in April or in and around April 19th or 20th. So the essence of the post was that when your new high, new low ratio starts to roll over from a high level, you want to look for a couple of things. You want to look for the trend of the rollover being pretty significantly down, and you want to look out for the falling below 70 line, which is bearish. Now, the chart that you're looking at here is a chart that you'd find on our website on the resources area in Little Big View, and by navigating in Little Big View to the market analysis and then the chart section, you'll find this chart. Now, in the last post, I pointed out there's a couple of other things that I didn't have room to cover in that post, and here's one of them, and a really important one. Generally, when the market starts to roll over, it can come down through the 85 level. Now, the 85 level we've got labeled as very bullish, and that means that if you're above this 85 level and flat, you're still bullish. If it starts to trend down as we see it here, markets might be getting a little weaker. Break below the 85, it's your first warning sign. Below 70, big warning sign that the markets are weak, even though the markets may be near a high. And that was really the critical point I wanted to bring to your attention, because if you look down below, you can see that the SPYs continued to move higher even while this indicator was deteriorating. But something happened here that doesn't always happen that I want to bring to your attention, and that is on the day when we gapped down, I believe it was the 4th or the 5th of April, the number of new lows was greater than the number of new highs. Now, this condition is happening at a point where the stocks are a day or two, or the indexes are a day or two from 52-week highs. So you shouldn't have your index just days away from its 52-week high and be making more new 52-week lows than new highs. That is not a healthy sign. Does it mean we're going to crash? Not necessarily. Does it mean we're going to start to consolidate, get choppy? Correct? Probably. So the combination of the trend being down for almost a month in the indicator while the markets continue to move higher, and a day that we see more new lows than new highs is a huge warning sign. And as you can see, it continues to trail off the indicator to break the 70, which is the big red flag that the markets don't have the leadership, they don't have the breadth that you'd like to see a market have. So when that happens, I am going to shift both a day trading strategy and a swing trading strategy to be more defensive, maybe even more aggressive on the shorts, but certainly more defensive from the long point of view. So how does that work? Well, in our day trading room, which is where I'm going to focus on for the rest of this video, I'm going to switch from a strategy where I might be interested in buying opening range lows and more aggressive about buying opening range breakouts to one of being more aggressive of shorting opening range highs and shorting through opening range lows. In other words, until the market really demonstrated the weakness that that indicator demonstrated for us, I'd be less likely to be aggressive on the shorts. Just wait for the right time to happen. Now, before I go to the intraday stuff, let me just grab a daily chart that's a little more visible and show you the SPYs and what we're talking about. So on this day, it was the gap down, that's how I remember it. So 4-4, April 4th, we had more new lows than new highs. Like I said, 2 days away from the 52-week high in the SPYs. That should not happen in a strong market. So for the rest of this time, I'm going to show you how, by using the 30-minute opening range and looking at it from the vantage point of a negative bias, you really had some nice trades, shorting highs and selling breakdowns. Now there's one other rule in here, and we've got quite a few rules to keep us on the right side of the markets in our day trading strategy, and I'm not going to be able to share all of them with you here, but you certainly could come to a trial of our day trading with hot scans room, and you can learn them. And in fact, this week I will be releasing a video for the members of the room specifically on what I'm going to call the 83% trader's advantage. And that's one of those rules that just keeps you on the right side of whether or not you should be looking short or looking long from a shorter term pattern point of view. The way we like to approach the markets is what's the big pattern, and then on top of that, what's the 1 or 2 day pattern, and then on top of that, what's the opening range pattern, and those three put together gives you a really tight handle on whether you should be long or short and your entry points. So we'll take a look at some of that, and what I'm pointing out with this video and with these blog posts is the new high new low ratio is one of many ways that is a really great way to keep track of the market and let it tell you when a trend which has been intact for a long time is beginning to kind of crumble underneath. As I said, it doesn't mean that it has to collapse, but it does mean that it's more likely to consolidate harder and consolidate longer. And so far, that's what we've seen. Now, the context of this video isn't looking for what's going to happen if we move lower, but if we do move lower through this flagging pattern right here at the 50-day moving average, which is this magenta moving average, it's a pretty significant negative tone, negative, and I would look for further declines based on the new high new low ratio, a couple of other longer term indicators, and the price action. That's a topic for another video though. So I'm going to start with a 5-minute chart, look at the 30-minute opening ranges, and just kind of walk you through how having a more aggressive negative bias starting with this particular day here has been really helpful and really powerful with just some basic understanding of the opening range. Basic understanding which probably, if you're a member of our email list, you've certainly had ample opportunities in the last couple weeks to get some of the videos, free videos that describe the opening range reversal type strategy that I'm about to show you. So the first thing I'm going to do is I'm going to show it to you on a 5-minute chart, and then I'll actually give you some views of how we look at it in the trading room where we've got our automated trading signals confirming entries and exits. So right now what you're looking at is a 5-minute chart, 5-minute candle chart. The candles are not important for this particular exercise. I do like to look at candles, but we're not looking at candle patterns here. I want you to just see how the market trades around this 30-minute opening range when we're in what I'm describing as a kind of a negative bias environment with the new high new low ratio being that guide. So we were already in the negative bias environment, but it was on this day, this gap down day, that we had the more new lows than new highs that would really set a red flag in my mind about and cemented the situation that the new high new low ratio, while it may still be over that all important 70 mark, was really much weaker than I think a lot of people we're paying attention to. And so what that means is we're going to look as traders for opportunities to now start selling the breakdowns below the 30-minute opening range lows. Prior to this, I was not all that aggressive about wanting to sell the market down. I might sell it higher, but wasn't going to get all that aggressive on the short side. Now I'd be more inclined to do so, and you can see why. In this case, we break down through the 30-minute opening range. Now at this point, you don't know you've got more new lows than new highs. So this was a negative day that maybe could wind up in a scratch. We tend to take profits at a certain distance from our entry point. I'm not sure off the top of my head whether we would have gotten it that day, but we definitely wouldn't have taken a loss. On this particular day, I'm going to show you the robots. We actually had a sell signal against this opening range high and did not get stopped out, but it wasn't much of a day. By the end of the day, it was pretty much a scratched trade anyway. On this particular day, the opening range failed once in terms of was the high, but then came back up and probably got stopped out there. The next day, however, is a big winner. Okay, coming in with a negative bias, seeing the opening range breakdown, big winner of a day there. The next day, selling the opening range high here was great for a move right down to the lows, and if you stuck with it all day, turned out to be a nice little trade as well. Now, as I said, I'm going to come out with a video, and if you're in the trading room, you know the rule already. But this gap higher here created a pattern that would prevent us from selling opening range highs here. So we actually wouldn't have gotten caught on the short side here. In fact, the aggressive long would have been long here because of that short-term pattern that I was talking about. I'm not going to cover that pattern in that video. We reserve that pattern for our members. So that day actually for us was a good day, not a bad day looking on the short side. The following day, however, we had a nice breakdown, and as I said, coming in and knowing that your opening range is going to be your guide, and if it breaks down below the OR with the right lineup on the short-term patterns, you have a nice take some profits, and if you stick with it to the end of the day, a nice trade there as well. Alright, so I'm going through these rather quickly because I'm actually going to show you the signals coming up. On this particular day, it's another breakdown day, and there's a good chance that you didn't reach the initial target, but you also would not have likely been stopped out, and you might have scratched depending on how aggressively you followed the trading rules. Stopped out with a no loss here, or if you stuck with it to the end of the day, which we often do, a small profit. Now here again, while it may look like this was a losing day, we've got a rule that prevents us from getting aggressive on the short side here based on the action relative to the prior day's close and the lineup of the day before. So short-term pattern kept us out of trouble on this particular day. That's the 83% trading advantage video coming up soon. On this particular day, you can see selling against the opening range high. We would not have gotten stopped out on this little of a move above the new high. And from a profit target, probably just missed it there. One of our profit targets being the opposite side of the range, could have been covering there. Either way, if you did or held it towards the end, you're on the right side of the market looking at it with a negative tone. Now, coming into the 19th, we would have gotten caught here. Selling the breakdown, definitely would have gotten caught, stopped out in here. However, the OR reversal pattern happens here, and taking that one more than makes up for the loss, plus, plus, plus as we go lower. If we look at the 20th, the last day, another example of selling the opening range high. I do not believe we got stopped out here. It turns out to be a good trade. So let me just give you a sample of how this actually looks in the trading room with our robots. Alright, so what you are looking at here is an example of what we use in the trading room to help us visually see the signals that are based on very specific trading rules. In the last segment, I was showing you a 5-minute chart and the same 30-minute opening range high and low so that you could see more data day to day, and I could go through the general patterns more quickly. But I just want to demonstrate that, what I was saying as I went through those charts relatively quickly is all done in our trading room with you or our members being able to see these signals so that we are mechanical about it, so that we've got an objective basis on which to trade. Now I'm going to go through this relatively quickly and just give you a sense of how the rules work and what the visual tools are like. So the opening range high is a solid green line now, and the opening range low is a solid red line. A profit target is a kind of a gold line, and the stop, which you can't see here, is up higher, is a solid red line. You'll see them as we go through. So I'm back on the 5th, which is right after the day on which I said we had that highs are less than new lows, and that was a major sign. And this particular strategy will only look to sell opening range highs, 30-minute opening range highs. I'll pull up another one after this and show you the 30-minute breakdown lows. So you get a sense of how really shifting to this bias has been a good one. The other thing that this strategy won't do is it won't take into account some of our short-term patterns that will override whether or not we want to be short. But I'll demonstrate that as I go through. So in this particular day, we're short as the market rallies up, takes out the opening range high, and comes back into it. If you've seen any of our free videos, they're not just generally available on the site, but in some of our product launches. You may recall you need to go out of the opening range, come back into it, have certain conditions, and then you get short. So in this case, you didn't get hurt much, but you were short for the majority of the day and closed it at the end of the day with a small loss or practically break even. So the next day we gapped down pretty significantly, and it's not surprising that after we gap down, hold S3, try to roll over at the 30-minute opening range high, and even though you had some money in the trade for a little while, the second time up, not surprising that we'd get stopped out. But you can see how the rules work. You can see that if you're purely mechanical about the whole thing, it's not perfect. Relatively small loss, a fraction of an average range. We look to take out half to a full average range on a day trade or more. So that one was a loser. But the next day, as you'll see when I do the breakdowns, was a big breakdown trade. We did not have an opening range reversal, so there was nothing there. The following day, opening range reversal, so we gap higher, get an opening range reversal here. You can see that turns out to be a really nice trade. Oftentimes we'll look to take profits if we just get down to the opening range low, but you can see that our target, the gold line here, was never hit. We're out at the end of the day, but nice trade, and considering that was where our risk would have been. Now the next day here is one of those days I described as the short-term 83% rule would have us override this. So yes, if you were purely mechanical, you would have gotten stopped out here, but we wouldn't have been shorting this based on a couple of different short-term patterns that we teach our traders. So for us, that was not a big deal. In fact, we have a long bias, long intraday bias, not a short one based on the short-term pattern rules. We go to the next day, we don't have an opening range reversal. And as a trader, this is a good way to look at the market. A very specific strategy. Is it qualifying on this chart? No. Does an opening range breakdown qualify? It will, but I'm going to show you that on a chart that has that strategy programmed into it. Okay, on this chart, the reason we don't get into the opening range reversal here is because it just blows right through the opening range, a strong breakout, and as a result, we wouldn't have even been triggered in. But we also have again a rule to protect us from this particular explosiveness. So even if it had come back in, we wouldn't be in that opening range reversal. Now, if you're a member of the Day Trading with Hot Scans room, or you've taken the AM Trader course, you should know these rules. But like I said, I've got a new video coming out I know you're going to love that's going to really clarify all these rules. All right, so the next day, we've got an opening range reversal. You can see the entry signal there. It's kind of a choppy day, so you had some opportunities or an opportunity to buy it against the OR low, as I said, which we sometimes do. But even if you didn't do that, holding it till the end of the day, modestly profitable. Now, this day, in full disclosure, would have had you taken an opening range breakdown here, getting stopped out. We're going to see that in the next section in a minute, but then getting short at the opening range reversal point, at a really great point to be short in terms of our short-term patterns. You take some profits here, hold the rest till the end of the day, which I don't have programmed in here. So we would have taken some here and some here if we stuck with it. We actually did take some at S3. When a market moves all the way to S3, you really need to be anticipating that's going to be support or resistance. And be careful. You might recall at the beginning of this video, one of the gap downs stopped at S3. That was the one where we actually got stopped out at. So S3 again would have been one of those points where you have to think twice about getting short after you've bounced off it, and you need to think twice about taking or not taking profits if you're all the way down there. But nonetheless, selling up near the highs, covering it at a profit target that's a good portion of the average daily range, and still having some to hold to the end of the day is a great place to be for a day trader. And then finally, on the 20th, a nice opening range reversal here that didn't make it to the profit target, but by the end of the day you're selling near the lows of the day. So that's how the opening range reversal has worked over the last several days. Let's look at the breakdown. Alright, so now we're looking at a chart that's focusing on the opening range breakdown instead of the opening range reversal. And if I start back here at the 9th, there isn't an opening range breakdown, so nothing to do there. On the 10th was the good breakdown day. You can see breakdown of the 30-minute opening range low level here. Our stop would have been this red line. Take some as it broke through the profit. It actually broke through the profit target so quickly we got better. And this one doesn't have the strategy programmed in to keep the balance to the end of the day, but that is normally what we do. Take some at the target, have some carry. In this case, it would have been a great trade near the close of the day. So the breakdown really worked. Not surprisingly, based on what I've already told you about the underlying condition of the market. This one's actually a good example of how, even though it broke the opening range here, we have criteria where it's actually got to break, stay below, clear a certain level before we get in. It wound up doing it right near the end of the day, didn't lead to much, but it was not bad either. Okay, so here's another day, the 13th. We break down, we clear all our confirmation levels. Short in here, have to sit through a lot of time, but by the end of the day you almost get to your target, but a nice trade. Now remember, these rules are so objective that the computer is doing it. All right, so that's what we strive to do in the room, is be that specific about it. Now in this case, as I said, they don't always work. By the time we get short with all the confirmation levels, we're short down here, and this is what a losing breakdown trade for us looks like. Relatively small percentage of the average range of the day, and nothing's perfect. That's what's going to happen. Looking for breakdowns. Don't know that there was any more. Oh, right. This was the tough day, but again, a great example. Got short below the opening range, covered when it didn't work, and then this was the day where we sold it again near the high of the day. So that's the kind of discipline that the opening range gives you, and with these objective rules on top of another set of criteria that keeps you out of some of the days that the opening range doesn't work. And here's another example, finally, of taking out the opening range, finally getting confirmed at the end of the day. Not much there. So hopefully that was a good sense of how we trade the reversals and the breakdowns. All the specific rules are what we teach in our opening range success formula and the AM Trader course, which you'll find right here on our website. The room where you see these signals generated is called Day Trading with Hot Scans, and we'll give you very specific rules on the entries and the exits, stops, and everything you need. So I hope that's helped. I hope, if you remember back to the beginning of this video, it's gotten pretty long. The whole idea here was the bigger picture had shifted because of that new high, new low ratio. We start focusing on the shorts. How do we focus on the shorts? We apply the strategies that you just saw. All right, so if you are a member of our room and you're seeing this, look forward to the 83% trading advantage. If you're not a member, this week I released the video Wednesday, I believe, is going to be a great week to do a trial, and that trial would be day trading with hot scans. And actually, anytime after this week, that video is going to be available for anybody who signs up in the member area. Hope that helps, and I'll see you in the next video.